Imagine retiring in January 2000 with $1 million. By October of 2002, though, your portfolio would be worth about $510K, barely more than half that amount. And you've also taken out $80,000 in withdrawals over those 2 years in order to pay for your lifestyle. You're now drawing nearly 8% from a portfolio that the market has cut in half. You didn't make one single wrong decision along the way, you just retired at the wrong moment, into the wrong portfolio. And sitting here in 2026, you might be thinking, thank goodness that's not me, right? But here's the thing. Right now, the most popular investment index in the USA, the S&P 500, looks remarkably similar to what it looked like in January of 2000. And if your retirement portfolio is a standard index fund, you might be holding something closer to that year 2000 portfolio than you even realize. Which is why in today's video, we're going to look at exactly that. The retirement portfolio trap hiding in plain sight, what it can cost you if you don't do anything about it, and what you can do to potentially help avoid it. So for those of you who are new to the channel, I'm John Norberg, CFP, and the owner and founder of Norberg Wealth Management. And today we're going to talk about what a lot of people consider to be one of their favorite investments. You see, most people who own an S&P 500 index fund carry a mental picture of it that goes something like this. 500 companies spread across the American economy, diversified across industries, with no single company or sector dominating the others. Diversification, right? And that picture was reasonably accurate, say 15 years ago or so. But in 2026, it's simply not the case anymore. Here's what the S&P 500 actually looks like today. The top 10 holdings in the index represent over 40% of its total value, the highest concentration recorded since at least 1972. In practical terms, if you put $1 million into an S&P 500 index fund this morning, $400,000 of that million went into 10 companies. The remaining $600K was spread out across the other 490. That's not what most people think of when they think of a diversified index, right? And this actually comes straight from State Street Global Advisors when they wrote an article back in November 2025. And by the way, it hasn't gotten better since. The sector picture is equally striking. Information technology sector officially accounts for approximately 34.5% of the S&P 500. Now, obviously that fluctuates a little bit day to day, but generally speaking, we're over a third in that one sector. But the truth is that that number actually understates reality, the true tech exposure. In 2018, a reclassification moved Alphabet, Google's parent company, and Meta, also known as Facebook, out of the technology sector and into communication services. If you were to add those back, the effective technology concentration in the S&P exceeds 38%. Healthcare, which is the second largest sector, sits at roughly 12%, a mere fraction, and financials are around the same percentage. The gap between technology and everything else is far wider than it has been for literally decades. And by the way, that communication services incident with Google and Meta is not isolated. Another example, PayPal. They've been in the news a fair bit recently. They were reclassified from technology to, again, financials. So State Street Global Advisors, which I mentioned a moment or two ago, they're one of the largest institutional asset managers in the world. And in their recent research, they noted that only approximately 44 names are genuinely driving returns across the entire S&P 500. That happens to be the lowest spread in over 35 years. The other 456 companies are, statistically speaking, largely along for the ride, right? Not making any meaningful difference to the return. Now, there is one important distinction worth making before we go further, because a credible analysis of the situation truly does require it, and it's important that you know. The technology companies which are driving today's concentration are not the dot-com era companies that we saw back in 2000, right? Apple, Microsoft, Nvidia, Alphabet, these are extraordinarily large and profitable businesses with true earnings, genuine cash flow, and real competitive moats. This isn't 1999, when companies with no revenue and no business model were trading at multiples that defied arithmetic and reality itself. The earnings picture is truthfully stronger today than it was then. However, there is a parallel to those dot-com companies, and that is in the AI sector. You slap AI on something, and that company immediately garners more attention than it would have without it. Now, this distinction does matter, but it doesn't change the structural reality of what concentration at this level means when a drop happens. And history has a very specific data point about the last time the numbers looked like this on the S&P. You see, the last time tech concentration in the S&P 500 looked like what I just described, what happened next was one of the most damaging sequences in the history of retirement planning. The data is worth looking at directly, especially the part that most market history summaries tend to leave out. And that's what we're going to talk about next. So let's talk a little bit about last time, the dot-com bubble, right? You guys probably remember exactly what happened. All of a sudden, everything with the dot-com on it was hot stuff. I even have family members who invested in dot-com companies and lost everything that they unfortunately had invested. So this does hit home in a personal way for me as well. And again, I say this to hopefully educate you guys that a quote-unquote diversified index fund may not necessarily be quite as diversified as at first point it might appear. So, official GICS IT sector weight does appear to be elevated at a standpoint that, again, it hasn't had since that early 2000s period. At the peak of that dot-com bubble, we're talking March 2000, right? The information technology sector represented approximately 33% of the S&P 500. So again, we're talking roughly, actually slightly below today where it sits when true tech exposure is measured. What followed after that point, March 2000, is one of the most documented sequences in recent market history. From March of 2000 to October of 2002, the S&P 500 index declined approximately 49%, peak to trough. That's not a correction, that's a drawdown that cuts nearly half of the value of the most broadly held index in America. Now, what's interesting is that the NASDAQ, which also gets a lot of attention in headlines these days, and is more definitively concentrated in technology, actually fell 78% during a similar time period, during that dot-com bubble burst. In fact, by the time that NASDAQ found its floor in October of 2002, it had erased over $5 trillion in market value, and it did not recover its March 2000 high until April of 2015, a decade and a half later. Pets.com, anybody? I still remember seeing commercials with that cute little dog. Well, unfortunately, that's a perfect example of one of those companies where the earnings just weren't there, and unfortunately, because it had that .com label, it attracted a ton of investment. So again, I say all of this not because I'm trying to scare you or make you think that you should never invest in the S&P 500, but to educate you and show that there are parallels, that while history doesn't repeat itself, it certainly can rhyme. And today, as we're facing a significant run-up in technology-based stocks, and especially anything with artificial intelligence in it, we need to be careful looking at history that we don't see it repeat itself or rhyme. Now, talking about that peak to trough recovery, the S&P 500, as opposed to the NASDAQ, did recover more quickly, approximately 7 years to reclaim its prior high. But 7 years is not an abstraction when you retired. For someone drawing down their portfolio, be it 4% rule or higher or lower, if that portfolio gets cut in half, that's the window in which true financial damage, irreparable damage, can get done. So let's talk about a little bit of mathematics here, right? Someone who retired with $1 million in March of 2000, who draws at $50,000 per year, that's a 5% withdrawal rate, watched their portfolio fall to roughly, as I mentioned earlier, $510,000 by October of 2002, before accounting for withdrawals at all. With 2.5 years of distributions already taken as markets are falling, the real portfolio value would probably have been closer to about $385,000 by the time the market bottomed out. They were now drawing over 13% annually from a portfolio that was a literal fraction of what they started with. Even as the market recovered over subsequent years, those early withdrawals, taken from a devastated portfolio, were shares sold at some of the worst possible prices, gone permanently, and therefore unable to participate in any meaningful recovery. That concentration existed in March 2000 and is now matched or even exceeded. You see, the forward price to earnings ratio, or PE ratio, of the S&P 500 is again approaching levels seen prior to that peak. According to State Street Global Advisors again, history again, does not repeat mechanically, but it is important to note that these structural conditions that made 2000 to 2002 so damaging for people who tend to make up the majority of our audience, that is, people getting ready to retire or recently retired, that is, elevated valuations, heavy concentration, and a portfolio that looked diversified, but when it actually cracked open wasn't, are factors that we're seeing repeat themselves here again in 2026. So, the concentration data tells you what the portfolio looks like, but what it doesn't tell you yet is why this is a categorically more dangerous problem when you're 5 years from retirement than when you're 35. And that distinction is the one piece of data that changes how most people think about risk entirely. And it also happens to be where this gets a little bit personal. As I mentioned, I had family members who were invested in not only S&P 500, but specifically in some of the sectors that suffered the worst. Technology, the dot-com, anything with, that whole internet aura about it. And so what I'm trying to do here is relate this to you so that you can avoid some of those same problems. So why is this different if you, like many of the people watching, are getting ready to retire or maybe recently have retired? Well, like I said, 49% drawdown could be survivable at age 35. You just don't sell, you keep contributing, right? You wait, the portfolio recovers, and that temporary loss becomes, in retrospect, a buying opportunity because you have that most valuable asset of all, which is time. That is the accumulation of an investor's experience of a bear market, and it is genuine resilience in action. But the retirement investor's experience of that same bear market is categorically different. And this is the point that changes how most people think about it. When you're retired, you sell, regardless of what the market is doing, because you have to support your lifestyle. In other words, if you're retired, living off of your portfolio, there comes a time when you have to sell pieces of that portfolio. Because your mortgage, your groceries, your health care, none of them pause just because the S&P 500 is down 30 or 40%. Every month, those assets that you need to live are leaving the portfolio. And in a down market, those sales would happen at a depressed price. The shares are gone and can't come back. And the portfolio that remains is smaller and diminished and yet still being drawn from and has to work harder just to stand still. There's some research out there from Mr. Wade Pfau, who, if you've ever heard of him, is one of the most widely cited academics in retirement income planning, that shows that approximately 77% of a retirement portfolio's final outcome is actually determined by what the market does in the first decade of withdrawals, the first 10 years. It's not your savings rate over a career or what the market did yesterday or tomorrow. It's really that first decade that determines how everything ends up. A bad sequence of returns in those early years creates a hole that the portfolio may never fully climb out of, even if markets perform extraordinarily well in subsequent decades. As we look back over the last 15 or so years of market returns, we've had, with the exception of maybe one or two bad patches, some pretty great, almost record-setting markets in some cases. This would have been a great time to retire, but what if it turns around over the next 15 years? You see, something I see regularly, and it's worth naming directly, is that the majority of DIY investors who come across my desk looking for a second opinion arrive with their largest allocation sitting in index funds, the S&P 500 or one of its close cousins being the tracker, the VOO, the SPYs, and the IVVs of the world. The standard passive vehicles that have served a generation of accumulation investors extraordinarily well, especially over the last decade and a half. But some of them have gone further. In the last several years, as tech returns have dominated headlines and performance tables, a meaningful number of pre-retirees have migrated specifically towards growth-specific sectors, the VUGs, the QQQs of the world, treating it simply as a more aggressive version of the same idea. But it's not the same idea. You see, the NASDAQ 100's technology weighting exceeds 60%. Its top 10 holdings represent 51.7% of the entire fund, and NVIDIA alone sits at close to 10%. When that dot-com bubble burst, the NASDAQ, as I mentioned earlier, fell dramatically and did not recover for 15 years. So pre-retiree holding the NASDAQ 100 as their primary equity allocation 5 years from retirement is not making an aggressive growth bet so much as they're making a sequence of returns bet, and they might not even realize it. And yes, technology has performed extraordinarily well, particularly in recent years and months as the AI boom has happened. But the question is, as your lifestyle is about to shift from accumulation to distribution, is this still the best distribution strategy to hold concentrated positions like that? For example, here's what this looks like in concrete terms. Take a couple, both in their late 50s, planning to retire in, say, 2 years, with $1.5 million in a standard index portfolio. Their statement looks pretty strong. They have been saving the last few years and they've had excellent returns. But what they haven't modeled out yet is what their portfolio looks like if the market replicates the year 2000 in their first year of retirement. You see, a 49% drawdown takes $1.5 million down to $765,000. And they're drawing $60,000 per year to fund their lifestyle. By the time the market bottoms out, they're pulling nearly 8% from a portfolio that was cut almost in half. And as per Vanguard's research, retirees who begin withdrawals at the onset of a major bear market can face an 81% portfolio depletion rate. Not because markets don't recover, but because the math of withdrawing from a diminished base makes recovery nearly impossible to outrun. That's the problem. Again, accumulation is an entirely different ballgame from distribution. And it's looked really, really good if you've just, boo and chilled, right? Put it into an S&P 500 index fund. Let the passive, low-cost investing do the rest. And again, this is not necessarily a bad strategy. In fact, it could be a very, very good one. But the game changes dramatically if you are getting ready to retire or already have and are starting to withdraw any kind of meaningful funds from this portfolio that might have significant swaths of its investments directly into index funds, which are heavily concentrated in just one sector. So again, this is why I bring it up, because this is the majority of the people watching this channel, getting ready to retire or having recently retired and facing this situation, perhaps without even knowing it. The accumulation investor tends to weather the storm because they have time left. But again, the retirement investor, the one who's withdrawing or getting ready to, often does not. Not because they made a wrong decision, but because the wrong sequence arrived right at the wrong time. Wrong place, wrong time. Understanding that risk is the first step, but the second step is knowing what to actually do about it. And the answer isn't to move everything to cash and get out entirely, or even to abandon equities entirely. It's more nuanced than that, and it's actually considerably more actionable than most people expect. There are complications sometimes that arise that I have conversations with my clients about, like capital gains. A lot of people come in and they've got NASDAQ-based funds that have run up significant capital gains, which that's awesome, right? Capital gains would be an issue if you didn't make money. But what do you actually do about it from a conceptual basis? See, the answer here, like I said, isn't just get everything out of the markets and into cash, or making dramatic portfolio changes based on a prediction about what the markets will do next. Because nobody, not Bill Gates or Warren Buffett or any of those gurus you see on YouTube or TV, knows what the markets are going to do tomorrow. And any advisor who tells you otherwise is probably selling you something. You see, the answer is more straightforward, and it actually begins with a question that most pre-retirees have never been asked to answer in a truly concrete manner. Understand what you actually own. Before any decision is made, pull up your fund's current fact sheets and look at the sector weightings. Most people are genuinely surprised when they see the numbers. If I ask them, what do you actually own inside that fund, and what percentages? You see, knowing that 38% of your equity allocation is in one sector is not a reason to panic. It's a reason to have a conversation that you haven't had. The trap is hidden in plain sight. But the first step is, again, asking yourself, what does it actually look like? And then having the courage to pull back those covers. Reconsider for a moment what diversification actually means here in 2026. Owning one S&P 500 index fund is not diversification in the traditional sense that most people assume. When the top 10 holdings were 17, 18% in 2015, that was a reasonable approximation of some broad market exposure. But at 30-40% concentration today, it behaves much differently under stress. True diversification in the current environment means actively managing away from concentration, not away from equities broadly necessarily, but towards a more balanced distribution across sectors, geographies, and market capitalizations that the cap-weighted S&P 500 no longer provides. By cap weighted, I simply means that each company is weighted by its capitalization. So the largest companies, again, think your Apples, Nvidias, etc., tend to get overexposure as opposed to a smaller capitalized company. So one possible antidote to this would be to explore equal weight S&P 500 funds, right? Not a specific recommendation here, but that's one possible way to avoid some of that. Now, another thing to think about is recognizing the risk of the sequence of returns window. When you're within that 10-year period before retirement, you have a vulnerability that no equivalent earlier life cycle in your entire journey towards retirement has. Again, what might be appropriate for a 45-year-old with years of runway isn't necessarily appropriate with a 60-year-old who's getting ready to retire in 2 years and start distributing. Sequence of returns risk doesn't care about your long-term average, your 15-20% plus returns. It only cares about what happens in the early years where withdrawals begin, like we talked about for Wade Pfau earlier. And that's where everything that you've built can hinge on you actually taking the time and the intentionality to plan around it. So building a floor is an important part of portfolio allocation. If you're going to have to sell parts of your portfolio, know what your cushion ought to look like. Whether that's 1 year, 2 years, 3 years of bonds and cash. And this is actually where, shameless self-plug. In my practice, we have what we call the bucket strategy, where we have cash that distributes on a regular basis to your account, just like your paycheck from when you were working. And then we have bonds, right, which is typically your more conservative investments that move around somewhat, but a lot less so than the overall market on the whole, typically. And then we have your stocks or equities, right, which those do move around a lot more. But even that piece of it, knowing what's in it, knowing how much is concentrated in any sector, is very important to what the holistic picture looks like as we're starting to divvy up the portfolio for distributions. So, the question worth asking, and perhaps even sitting with, isn't necessarily what is the market going to do, but whether your portfolio is built to survive the answer if it's the wrong one. So, if this has piqued some interest or some concern about where you are, what your retirement plan means based on what's actually showing up on your statement, and what could be showing up there this time next year, then I would welcome a conversation. There's a link down below, right in the description of this video. Go ahead and click it. Take 5 minutes to walk through a brief questionnaire and book a call with us. We'd love to have a chat with you about what your goals are, what your portfolio looks like, how the two align, and how we might be able to help. In the meantime, I'll see you out there.